All right, good afternoon. This is Aristotle Cuppis with RealWealth, and I'm one of the investment counselors. I've been here for about 7 years now, a long time. Wow, time is going by fast. But today we're going to be talking about lending options in a rising interest rate environment. I'm sure everybody on this call is interested in just learning what interest rates are doing, where they're going, how can I still buy investment property, it's still cash flow, et cetera. It's one of the most important things people are talking to me about every day. And so we're going to definitely dive into that. Down there on the corner of your screen, you'll see Shawn Huss. How you doing, Shawn?
Doing super. Thanks for having me, Aristotle.
Yeah, thanks for joining us. So Shawn is with Warsaw Federal. We're going to dive into that in just a second here, but I just wanted to acknowledge him. But yeah, Shawn's going to be talking with us today about interest rates and kind of some strategies here. So I want to announce real quickly, join us in Tampa. So a lot of you have probably seen the Tampa email that went out. We are having our first live event in over 2 years. Pretty amazing, but we're really excited to have anyone who wants to join us there. You can go to our website at realwealth.com/Tampa event and get information on there. The dates are right there, of course. It's Friday, May 20th and the 21st. So Friday will be like a cocktail hour, so like a meet and greet that Friday night. And then Saturday is going to be the live event. Again, this is all in Tampa. And then Sunday, we're going to do a property tour. So for anyone who's interested in the Tampa area, we're going to have a tour on Sunday from 9 to 2, give or take. And then on Monday, if anyone's interested in staying an extra day, we're going to have a small little tour up in the Jacksonville, St. Augustine area. So with a different team, different area, of course, but if you're interested and you're going to be in Florida, definitely join us for that. So again, go to realwealth.com/Tampa event for more information. All right, upcoming webinars. So the next Thursday, it's already May, I cannot believe it. We're going to be talking with our Baltimore team about their income properties, and they have quite a bit of property that they're able to offer nowadays. I'll be hosting that one, I believe, and then the Thursday after that, we're going to be talking with one of our 1031 exchange facilitators, with Dino Champagne, talking about how to do 1031s in this fast-paced environment. So you can check our website out for that, or just stay tuned for emails on those upcoming webinars. Go ahead to the next slide here. So as always, I got to read our disclaimer real quickly here. And it basically says that the strategy mentioned in the presentation or in this presentation may not be appropriate for everyone, and other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, and/or attorneys to discuss your specific situation. Past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exist. So RealWealth is not, we do not give legal advice. We give general advice, but yeah, definitely seek out tax advisors, things like that, if you have questions on that type of stuff. Okay, so I want to introduce Shawn here. Again, this is Shawn Huss. He's the Senior Vice President Mortgage Lending with Warsaw Federal. Now, a lot of you might have heard of Shawn. If you're not new to our company, if you've been a RealWealth member for many years, you'll probably recognize Shawn. Shawn has been with us for, I don't know if it says on here actually, but he's been with us for probably over a decade. And he's been with several banks. I actually personally use Shawn on many of my personal real estate investment loans. He's fantastic to work with. He is one of our preferred lenders, and his information is also located on our website. But he's been ranked in the top 1% of originators in the country for the past 20 years by Scotsman Guide and Mortgage Executive Magazine. I'm not sure who that is, but sounds like a very popular magazine and information there. But yeah, that's pretty awesome. He's ranked top 1%. He's done over $2 billion of financed loans in the 29 years in the mortgage industry, which again, a lot of history here. He specializes in investment and owner-occupied lending, new home purchases, home refinancing, cash out and no cash out. And he's joined Warsaw Federal in 2022 this year as Senior Vice President of Mortgage Lending. And again, he's been with us for a long time. And again, if you remember way back in the day when I first met him, he was with a bank called TCF. That's where I first did my original loans with him. He's just fantastic to work with. He can close loans very quickly. You need a lender, especially in this market. You need a lender that can close loans very quickly and just can really, really nail the investment loan down. So Shawn, welcome. I appreciate your time again. Thank you for joining us today.
Awesome, Aristotle. Thanks for the introduction, and appreciate the partnership I've had with the RealWealth group pretty much been over 15 plus years. So again, as Aristotle mentioned, I just recently switched jobs, went to a smaller community bank, and I can explain a little bit why. So we do specialize in the investment business. Not many banks are familiar with the ins and outs of investment lending. Having the right partner as you proceed moving forward to grow your real estate portfolio is huge. In the last 4 years, this is only my second move in my 29-year career. So as Aristotle mentioned, in 2009, I joined First Place Bank. They merged with Tomer, they merged with Chemical, they merged with TCF, they merged with Huntington. So obviously with every merger, the bank became bigger and bigger. They had the right products, but they moved to centralized processing. Their fees were increased. So at the end of the day, myself and my 4 assistants all decided to leave the bigger bank mentality to go back to smaller bank to gain more control, to have a better customer experience, a better referral network experience. So we've been over here since for 90 days. We're going strong. The business is still coming in the door. People are slowly finding out where we went to. Again, having that partner that understands investment lending is huge as you continue to grow your real estate portfolio, because you just want somebody who's going to tell you the goods and the bads and be straight up with you guys. And that's why basically I've had a great relationship with Aristotle, the other affiliates with the RealWealth group. So basically what I'm going to do is kind of have a couple conversations on about interest rates. Why are the interest rates going up? What's happening in the market? Believe it or not, we're still busy. So the rates went up very, very quickly in the last 60 days. I mean, when you're looking at the 10-year Treasury at 1.66 and jumped all the way up to 3%, we're seeing a 1.5 to 2% increase in rates in a very short window. So everybody has been shocked by it, but there are still a ton of opportunities out there. The investment opportunities basically are still viable to continue to grow your real estate portfolio. With real estate investing, I mean, there's reasons that you dive into investment property lending, passive income. Basically, you're looking and locking into a fixed rate product today, basically while you're looking at rents possibly increasing to increase cash flow, basically with looking to get a long-term hold. We'll talk about different options on the mortgage rates and kind of give you some examples of where they're at today. Growing net worth, obviously in the last year, especially during COVID, we're seeing a lot of appreciation. So you're seeing a lot of appreciation in basically values are climbing, so that's positive. And then obviously you got appreciation in your tax benefits. So there are a lot of income benefits of owning real estate to grow your real estate portfolio moving forward. I mean, we're looking at stock markets. I mean, the fluctuation of stock market up and down. Obviously, people jumped into Bitcoin, and that's a real variable. But I think you see a consistency in the real estate world that you have an asset that you buy and hold, even if values go up and down, there's still cash flow that's going to benefit you. So basically, making money with real estate investing. Again, as I mentioned in the last slide, having the right partners is huge, especially in today's market. Supply and demand is way off. There's way more demand than there is supply. So that's where you're going to rely on a good partner such as RealWealth Group. They have 14 affiliates all over the country. They kind of work together to maximize the best opportunities for you guys on this call. The key is with RealWealth, they help you diversify. So buying some, I have some clients that will buy some in one market. They'll go switch to another market. So they'll buy 3 in one market, 3 in another market. What we're also seeing a lot is because there is not much supply, we're seeing new construction be a bigger part of the pie. And what new construction is they're finding properties to build properties, and you're putting a larger deposit up front than you usually get an end loan in the very end. Every market's a little bit different. You're not going to find many lenders out there that do construction lending. So that's where you might put up a 10-20% deposit up front to help that builder get that property completed. And pretty much you're looking at the end loan. A key point about the construction loan is we don't know where rates will be tomorrow, let alone 6 months from now. So Warsaw does have a nice program where we can do an extended lock period for like 8 to 9 months while that property is being built to kind of protect the interest rate. Again, we don't know where rates will be tomorrow, so that's a key point of having a rate protected. The cost will be slightly higher to have a rate protected for 8 to 9 months, but it is an option that we'll have that conversation if it's something that comes through. Again, buying in different markets, diversifying your markets. I've seen people buying some in Florida, some in Indiana, some in Cincinnati and Ohio. So again, that's just a different way to diversify your portfolio so you're not stuck in one environment if one market was to have a different effect than another market.
The other benefit is if you're buying a rehabbed home through RealWealth or what we call a real turnkey property or even a resale property, the prices are fixed, okay? Nowadays you're still seeing crazy bidding wars. Hopefully it is gonna shift, it's shifting a little bit, so it's gonna slow down. But one of the benefits of using RealWealth is fixed pricing on the renovated homes. So, you know, it's first come, first serve, of course, but we don't have bidding wars. So if you're tired of working with agents, trying to secure a property, that's one thing. On the new construction, it's a little different because these builders have a really hard time. The small builders that we work with, they have a harder time trying to lock in a price because obviously they only buy so much bulk material at one time. And so we've already seen some price increases on some of the new construction. But if you're buying the rehabbed homes like in Indianapolis or Cincinnati, like you mentioned, those are fixed pricing through our company. So there's no bidding wars, which is pretty awesome.
That's a great point. And also, again, these people are experts in finding the product out there. Since there's not much supply out there, using local real estate agents is fine, but they're not specialized in investment lending. Whereas RealWealth Network, they have a list of people. They know who the people are waiting for that next property. And Aristotle and the rest of the counselors, they do a great job of preparing you guys up front to make sure you're pre-approved, to make sure you're the first one in line as these properties become available. Is that accurate, Aristotle?
Yep, that is accurate.
Excellent. Help. Today's interest rates are killing my potential ROI. Real estate investors everywhere. So again, there's demand is way above supply. So what we need to do is kind of look at today's mortgage rates, look at what your options are. We might have to be a little bit more creative in today's market because rates going up 1.5% to 2% in the last 60 days. But again, the market hasn't really slowed down because of mortgage rates. The market slowed down because of supply. So we're still taking apps every day, getting the deals in the door. So again, for you guys as investors, do not be discouraged by the interest rates. Your ROI is still going to be there, and that's where RealWealth is going to help you look at those scenarios and educate you on why it's a good investment in that scenario. So here, what I've done is look at getting creative with interest rates where they're at today. These are live rates as of today. So again, the market changes every day. So these are making the assumption of a 740 plus credit score. So with rates going up so far, we have had to look at different options, maybe to get more creative. Every situation is different for every different investor. So there is no right path. So as a mortgage consultant, my job is to work with you guys as the buyer, as the investor, and help you figure out what path works best for you. So like for instance, a 30-year fix today with 20% down with excellent credit scores, you're looking at rates at 6.25%. Now that's with no points. So you do have the option to buy points, to buy a lower rate of interest, which helps your monthly cash flow. A point is equivalent to 1% of your loan amount. So if you're borrowing $240,000, 1 point is $2,400. In today's market, again, everything varies day to day, but like 1 point would buy your interest rate probably 0.375 in rate. So it would be at 5.875. So as an investor, what I do with my people is I send you a chart of different rates, shows you the principal and interest. In this scenario, if you paid 1 point to get to 5.875, your difference in payment will be roughly about 54 bucks. So 54 divided by 2,400, your basically break-even period would be less than 4 years. So that's a different way to look at it, that we have positive cash flow up front. If you're going to have the property for more than 4 years, basically your break-even, it might be in your best interest to pay the point to buy the lower rate of interest. Another way to get a lower rate is option 2. If you were to put 25% down, you basically will get about a 0.5% cheaper interest rate. So again, what happens is Fannie Mae and Freddie Mac, the two major institutions that govern all lenders, they have what's called level loan price adjustments that the more you put down, the better your situation becomes. So as you will see here, 5.75 as of today with no points. Still with that option, you have the opportunity to pay points to get the rate even lower. So again, it's nice to have the options of 20 or 25%. Every person's situation is different. Some investor might want to only have 20% and they don't want to put 25% down, they want a 5% head start on their next cash flowing property. But if you can afford the 25%, obviously you get a much better situation with a much better cash flow. With rates climbing so quickly, this is another option that has basically, we've started using in the last 2 to 3 weeks, is a 10-year adjustable. So what a 10-year adjustable is that means the rate's fixed for 10 years, it does not change, but it's amortized over 30. Obviously, there's more risk associated with that program. So again, it's a matter of, if you're looking at long-term holds, you might want to stick with the fixed rate products. But if it's a property that's 7 to 10 years that you know you might refinance or you might get out of it, it's a great program because obviously you see the big difference in interest rate. You're going from 5.75 to 5.195. If you were to pay a point, you're going to get your rate under 5%. So again, there's more risk associated with that. But again, every situation is different. Speaking with Aristotle earlier, even the higher priced homes, you might get out of the property in 7 to 10 years to take advantage of the appreciation. But again, that's forecasting today, which we don't know what's going to happen tomorrow, let alone 7 or 8 years from now. Aristotle, anything you want to add on in this slide or the ARM products?
Yeah, no, these are great options. Yeah, so what I've been recommending to the people I've been speaking to, the members I've been speaking to, is 25% down. I mean, it's usually the better bet. It's not a whole lot of money more down in the long run, but like you said, it's going to give you the better rate. And then on all the loans I've ever done with any investment property, I've always brought the rate down because I'm a buy and hold guy. I'm going to hang on to them for a long time. But option 3 is pretty interesting. So option 3, I think, would come into play for people, like we give the example of a new construction home here for 300,000. And yes, we have new construction that go up to 400,000 or even higher, but this is just one example. But on a new construction home, you know, let's say in the greater Charlotte area or one of the hot Florida markets or the Dallas market, you know, those areas are just, I mean, in my opinion, there's lots of jobs and lots of people moving there. You know, appreciation is not guaranteed, but for some people, I've talked to some members and, you know, maybe they're going to be retiring in 5 years and maybe they want to cash out and move to the Bahamas or something, right? Well, maybe that ARM product is great for them because you're going to have a lower interest rate, your cash flow is going to be better, but if they plan to sell it in 5 or 10 years, it's going to be a better product. But if you're buying a, you know, $100,000 property in Birmingham, Alabama, probably doesn't make sense to do that, you know, because you're probably going to hang on to it for a long time. I mean, you're not going to get a lot of appreciation out of that type of market. Or like Cincinnati, you know, depending on where you're at, but traditionally those types of markets are linear, and you're not going to see, you know, the 6 to 10% appreciation. So the ARM would be better, in my opinion, for a home that's going to have more potential appreciation. But yeah, so I love all these options here. I definitely love all these options here.
And just to add to the 10-year ARM, the 10-year ARM hasn't been a part of the conversation for the last 3 years. So with the rates going up so quickly, I mean, the ARM products were higher than the fixed rate. So if somebody's saying, well, I was never presented an ARM 6 months ago, it wasn't an option. But now that the fixed rate products have gone up so quickly, now you're seeing a 1/2 to 5/8 difference in rate. It could make a huge difference on the 30-year fixed product. And after 10 years, you will probably have a better equity position in the property because you're not paying as much interest.
Right. Hey, Shawn, what about interest only? Do you do interest only loans, or is that not a Fannie Freddie product?
That's not a Fannie Freddie product. So not many banks are doing investment. Fannie and Freddie does not do interest only on investment properties. That's what helped get us in trouble in the 2008, 2009 product.
Yes. Oh, and speaking of that, yeah, I just want to make sure people realize whenever people hear ARM or interest only, they get kind of scared. They're like, oh my gosh, no, I don't want to do that. You know, I mean, mortgage meltdown 2008, right? But you know, again, it's like Shawn said, there is risk with that type of program, but just know what you want to do. And as an investment counselor, me, Leah, or Joe, all 3 of us here, we do free strategy sessions. So if you haven't had one with us yet and you're trying to figure out which route to go, you want our opinion, again, we can just give you general advice, but we might recommend or suggest a certain route that you go versus another one. So definitely let us know about that. And Shawn could do that too. You know, when you contact Shawn, he's going to go through your scenario as well, because Shawn's an investor and he knows, and so he might say, I recommend doing this versus that.
Aristotle, do you want to, this is kind of like a pro forma on one of the loans. So I don't know if you want to kind of go through it, Aristotle, and kind of show an example of 300,000 with different down payments and interest rates. Obviously, it looks pretty story, but I'll let you add any notes that you would like to put in there.
Sure, yeah. So this is kind of, if you've been on, the members have been on our website, you know, you'll see some of the sample properties and kind of how we break it down here. Pretty simple to understand here. But again, this is based on a $300,000 purchase price. You can see the first column is the 30-year, 20% down. The second column is 30-year, 25% down, and the third column is a 10-year arm with 25% down. So you can see the down payment is about the same, except on the third column you got 25%. I'm sorry, the second and third column are the same because you're putting 25% down. We're estimating this to be at a $6,000 closing cost. Shawn, you could probably help elaborate that too, but I know we were kind of basing this property in the state of Florida, which Shawn was mentioning. Florida has a little bit higher closing costs, but this is typical closing costs that Shawn would be seeing, or that you would be seeing with Shawn's bank. And Shawn, and one thing we didn't mention is that with Warsaw Federal, the new community bank, the community banks seem to have, or your bank has lower closing costs, and you can probably elaborate about that real quickly if you don't mind talking about that.
No, not at all. And again, this in Florida, the state of Florida probably has the most expensive closing costs. If this property was in Ohio, Indiana, Alabama, you're probably looking at about $3,500, $4,000. So again, this is based on a Florida property. With Warsaw Federal, our bank fees are $9.95, so we're less than $1,000, which is $300 to $500 cheaper than all the other lenders out there. And again, our pricing tends to be is very competitive, maybe pretty aggressive. So we are finding ourselves very competitive when other investors compare us to other institutions.
Yeah, that's great. I mean that's one reason why I really love that community bank that you're working with, is lower closing costs. I mean, who doesn't like lower closing costs? So rehab costs, again, this is brand new construction. We're referencing some new rehab costs there. So here's our initial cash invested. You can see 66,000 on the first one, 81,000 on the other two. Principal and interest, you can see this is your payment right here. So monthly payment would be $1,478, give or take, based on the 6.25. You can see the difference in payment on the other two. So obviously the ARM, I mean, look at the difference in your payment there. I mean, it's more than $200 difference. I mean, that's quite a bit of difference there. Taxes, we just put 301 for taxes. Again, this is estimated. HOA, a lot of the new construction that we're doing are infill lots, so they do not have HOAs or associations, but there are some, and if there are, it's 20, 30 bucks a month, not a lot. Insurance is estimated at $55 a month on these. Property management, $111 a month there. Total monthly cost. So let's look at the net operating income, or the total monthly cost here. So it's $1,945 for the 30-year down. 30-year fixed, 20% down. $1,777 for 25% down, and $1,702 for the 25% ARM. So, and the income is estimated, the rental income is $1,850 a month. Could come in a little higher, could come in a little lower, but this is a pretty good estimate of what this house would rent for. And you can see the first column, yikes, negative $95, right? Why would you do that? So again, this is new construction, right? You certainly don't advocate you being in a negative cash flow position, but look what happens when you go to 25% down. Look at the second column there. Your cash flow is positive $73. And then you go again, look at over to the third column, that the ARM is $148 a month on new construction. So again, the first and second column and third column, you can buy the rates down, and those numbers are going to vary. Can you do a 20% down and buy the rate down to make it break even? Probably. Right, Shawn? Would that be a good guess? You could probably break even?
Most definitely.
Yeah, or maybe even above. And some people might say, well, why would I buy a new construction home and break even? Well, there's lots of reasons. I mean, I know a lot of people that buy investment property for the tax benefits. I mean, some people make a lot of money, a lot more money than a lot of other people, and they get taxed a lot, right? So they need tax benefits. They don't need the cash though. Do you want to be in a negative cash flow situation? Absolutely not. But if you're, 20, 30, 40 bucks a month and you're getting tax benefits from a brand new house, that might be beneficial to you. If you are a cash flow investor, yeah, putting 25% down on a new construction or even the 10-year ARM is going to be a lot more beneficial. So, so again, these are all based on different, on the 740 or plus credit score and based on no point buying down. So just, this is it's a good illustration to kind of let people know. And again, if you buy a home in Indianapolis for $150,000 or one in Birmingham or a $220,000 house in Tampa, these numbers are going to be a lot better because those are rehab homes. This is new construction. New construction is not for everybody, but definitely a good scenario here for people who are looking for new construction.
And so, and just to add one more point for the newer investors, although it shows negative $95, it doesn't take into account that your principal and interest is $1,478 is paying principal down on your mortgage. So it's probably not a negative once you separate principal and once you separate interest. So that's just something that on paper it looks like a negative, but once you break down the P&I payment, it's probably positive.
Yeah, good point. That's a really good point. Yeah, let's talk about these other options here.
Okay, so obviously there's other options out there for investing in today's world. So I mean, you have your 30-year fixed. Minimum down payment you can do is 15%, believe it or not, on a single family. Most investors will go ahead and put the 20% down because PMI on a single family can be pretty costly. On a multifamily, the minimum down is 25%. Obviously, to help get the better ROI, better cash flow, you can choose to pay points. So we had this conversation earlier. 1 point is 1% of your loan amount. So in this specific scenario, 1 point would be 240 on 240,000 would be $2,400. So if you spend 2,400 extra at closing, that would buy your rate down from 6.25 to 5.875. Once you do the break even, it's like under 4 years. So again, those are just options that help basically get a better ROI on any specific property out there. Obviously, you can put the 25% down and still get a much lower interest rate and pay points. So that's where we were talking about the higher down payment. One thing I've seen pick up of recent is a lot of refinance activities, whether it's a primary residence or investment property. So this is just a creative way to use your asset that's stuck in your a property. So I have investors basically because of the recent appreciation in value, you can get 75% out on a single family or 70 on a multifamily. They're basically taking advantage of the equity they have in a specific property and pulling it out so they can buy another income producing property. So they understand they might be paying a slightly higher interest rate because rates have gone up. In some scenarios, at that stage, we kind of look at the cost benefit. What are they adding on the other side by buying another investment property that is a great cash flow situation? So again, just something to kind of think about, that you might not want to liquidate the stock market right now because it's on the downside a little bit. This is another opportunity to use some assets that you have in order to continue to increase your real estate portfolio.
But my question to you, Shawn, is this. I've heard a lot of, there's a lot of noise in the marketplace, a lot of noise with everything, market crash, real estate crash, this and that. One thing I've been hearing is that some people say that over the last, 2 years of rates being, well, I don't know if it's been quite 2 years, but a year and a half, let's just say, that people have been taking money out, doing, refinancing. Would you say that, and I don't mean to put you on the spot, but would you say that more people just did a straight refinance in the last couple of years to lower the rates, or would you say there's a lot of people pulling money out of their homes? Because some people are thinking, well, if there's a lot of people pulling money out of their homes, isn't that going to over leverage people, and won't that kind of hurt the real estate market? Won't we see more foreclosures because people are overstretched and things like that? What's your take on that?
I think we're in a completely different market than we were 2008, 2009, where we saw the crash. So you're not seeing, back in those days, you were having interest-only programs. They had stated income loans. It's a much stronger buyer in today's market. So we don't foresee foreclosures being an issue. I mean, in today's environment, the investors are 740 plus credit, excellent income, excellent assets. So at the end of the day, leveraging the mortgage, your real estate asset to acquire more. I mean, we're seeing a lot of that take place. I mean, before the rates went up, we saw a lot of it also because they thought they could invest some of the cash, whether it's in more real estate or in the market. That was when the rates were slightly lower. So it's a different scenario right now. People aren't taking cash out refinances to invest in the market today. We're seeing them take cash out refinances to continue to purchase additional investment opportunities.
Yeah. Okay. Yeah, I just want to get your take on it because, like I said, there's so much confusion, and for people who lived through the 2008 financial crash, left a bad taste in people's mouths. So we have a lot of investors that are new, maybe on this call, and they're thinking of investing, but they're kind of like, well, I'm not sure. This is like a bubble, and I'm not sure. But to your point, yeah, I mean, I've been in real estate for 13 years, which is not a long time, but I long enough to know. I started right when the financial crash happened. And ever since then, loans have been extremely, I mean, you still need to you need to be an extremely strong borrower. I mean, credit score, collateral, I mean, everything. And so that's why you're not seeing a pick a payment type of loans, if you remember those, or like I mentioned earlier, interest only. They're not doing those. You have to really qualify for a loan, and that's important.
Yeah, and it was crazy lending back those days. I lived through it. We call them stated loan, liar's loans. I mean, if you didn't qualify, just make up the income as long as you had a specific score. So they set themselves up for what happened. So in today's market, I mean, it's a well more qualified buyer purchasing these properties moving forward. So I don't foresee any issues. I think it's a bit harder for somebody to walk away with the property with the equity it's in it today of 25%. And then where we were in 2008, 2009.
Do you, I'm sorry to go off on a tangent here, but do you offer, for self-employed individuals, do you offer bank statement loans? Is that a Fannie Freddie product or no?
No.
No, so you can't.
It'll come with a slightly higher rate, but there's investors out there that will base it just on the rents of the property. But again, that would be like a portfolio type lending, which comes with slightly higher terms.
So how do you deal with someone who's self-employed? Maybe they've owned their business for 20 years. I mean, can they still get financing? I mean, how does that work?
Great question. We deal with self-employed buyers every day. So basically, because you're self-employed right now, we have programs that sometimes we might only need 1 year, sometimes we might need 2 years. And when I say we might need them, we run the system through Fannie Mae, Freddie Mac, and they'll kick out the results and say, you only need 1 year for this specific borrower. You only need 2 years. So calculating, that's self-employed income. Then there's creativity that has to take place based on calculating rental income, based on how you're putting it on. If you're Schedule E, you're putting it in an LLC. So you got to be aware of how to calculate that income, whether you bought that property last year and we don't see it on your tax return. At that stage, we'll give a lease and use 75% of that to offset the payment. But once it enters your tax return, then we have a specific formula that calculates the income on each specific rental property. So there's a little.
Awesome. Yeah, okay, great. Awesome. Okay, let's go ahead and you can go to the next slide here. Oh, there we go. Questions. Perfect timing. So yeah, it was a very short but sweet presentation, but we have a lot of questions here. So I would definitely like to address those because everyone's got questions here. So Shawn, I'm going to go ahead and go through some of these questions here. So Rory asks, does no points also mean no origination fee?
No, great question because it's origination points just came around the last few years. Origination points are the origination fees are the bank fees. So it covers processing, underwriting. So it is not points to buy the specific interest rate down. So there is some confusion to that, but origination fees are the bank's cost.
All right, good explanation there. Okay, Joe asks, on the ARMs, what's the maximum they can increase each year?
Great question. So with the 10-year ARM, you're going to hear the term 525. So basically, it's 5 percentage points over the life of the mortgage. So that's the first one. They just recently switched ARMs to 6-month ARMs after the 10th year. So after the 10th year, it'll adjust every 6 months, and based on the market, with a 1% cap each 6 months. So it's 2 percentage points per year. When you hear the 525, the very first adjustment only, it could go the full 5% up or down. Then after that, it's every 6 months, 1% higher or lower. Most people, if you're entering that 11th year, you're going to refinance it into another product at that time, or pull cash out or put it into a fixed rate product. And a good thing to mention about the ARMs, if we think we're in one of those cycles where the federal government's going to raise rates a few more times this year, and we think rates are going to come back down in the next year, next 24 months, an ARM product is attractive because you can always refinance out of the ARM product into a fixed rate product. There is no prepayment penalty to do that.
Okay, gotcha. Thanks. All right. So Rory also asks, are these conforming loans limited to 10 per investor?
Yes, sir. 10 finance properties per investor. So if you have a primary residence, that counts as one of your 10. If you have a second home with a mortgage, that counts as one of your 10. Keep in mind, when you go to buy a primary residence, you can have 20 finance properties. It's only when you purchase a second home or investment property that the 10 factors in.
All right, good. David asks, he's looking at a duplex. Are rates going to be higher on a duplex than a single family home in these options?
Yes, on a two-family, the minimum down payment is 25% down. So the only additional fee is you're going to pay 1 extra point for being a 2 to 4 family. So like if you went back to our example at 5.75 with 25% down, it'd be the same rate, but you're paying 1 point. Or we can look at a higher rate of interest to put that 1 point in the interest rate, but they are slightly higher on multifamilies.
Yeah, okay, gotcha. All right, Lisa is asking, she said, bottom line, what's the estimated lowest rate for investors with the least amount of buy down cost? I don't know if you're able to answer that.
That goes back to this, that's as of today. It changes every day. So at 6.25, assuming you got 740 plus scores, that would be a 30-year fix would be at 6.25 today with 20% down. Then I think we were at 5.75 with 25% down based on the previous slides. But again, it changes every day with the market.
Okay, so basically with the 30-year fix 25% down, no one could get under 5%.
You could get under 5% by buying points lower. Is that what the question was?
Well, I guess you're saying what's the bottom line. So like, I guess someone, like what would somebody, if someone had to pay, like you could, I mean, I'm assuming she's probably asking this too, like how many points could you actually pay?
If you paid 2 points on a 25% down, you'd probably get a rate near 5%.
Okay.
So 2 percentage points, and then on the 10-year arm, it might be only 1 point to get a rate below 5%.
Right, right. But on that example, you'll be paying $4,800
on top of all the
for 2 points. Right, right. So you need to keep the property for close to 10 years before you actually recoup that money. Is that right?
It'd probably be a little bit less than that, 5 to 6 years, break even.
Okay, okay. All right, Chuck says, assuming a bubble happens, what will be the likely scenario? Well, I don't know really Chuck, what you're asking, referring to, but I mean, these loans are fixed, right? Well, if you get a 30-year fixed loan, you know, your payment's not going to change. So I'm not sure, but and no one knows what the rates are going to be. But I can answer this, and Shawn, you can, if you want to kind of chime in too, but there isn't really a real estate bubble happening because there's no foreclosures happening. I mean, there's very few. Every month, more and more people are exiting out of forbearance. And Shawn, I'm sure you've seen that. Many people have been exiting forbearance. People have equity in their homes. They're in a pretty good position now. So we're not seeing, like what Shawn says, we're not seeing a 2008 scenario all over again. But where we are seeing is that the rates are going up to slow things down because the demand for home buying has been ludicrous. And then all of a sudden we slammed the brakes on 30 to 60 days ago, and everyone went flying forward, and the rate went to 6%. Okay. EB says, can you keep buying down the interest rate, or is there a lower limit on the interest rates?
There's a limit on the interest rates, and it can vary based on, there's a limit to the points, and it's based on loan amount. So when you buy investment properties, there's a formula that says you can only pay a certain amount of closing costs based on your size loan. So again, that question can be wide range depending on if it's a $75,000 mortgage or a $250,000 mortgage, but there is a limit. Most investors aren't going to be paying 3-4 points on investment property. It might be 1 or 2 points in the investment lending community. Yeah.
Okay, great. Evie also asked, this is a question we talked about earlier, how should I think about buying down the rate versus putting more down after the down payment? And what we said earlier is that if you put 25% down, you're going to get, what did you say, Shawn, a half a point?
Yes, sir.
Yeah, so if you put 25% down to half a point, if you put 20% down and you buy the rate down, it's a 0.375.
So I think again, that's where we kind of step in and help you look at the numbers. So it might, if you pay 2 points and you get a payment equivalent to 25% down, you might say, you know what, I'm going to hold that 3% in. I only want to do 20% down. And so basically that way you have a head start on the next rental property you purchase. So again, every situation is slightly different.
Yeah, okay. And Gayan was asking the same, can you finance in LLCs? And can you talk about that real quickly again?
Yes, sir. So Fannie Mae and Freddie Mac does not allow you to close in the name of an LLC. Fannie and Freddie recently changed their guides that you can request permission from your lender to avoid the due on sale clause to transfer to an LLC. So each lender has different requests and different requirements. So pretty much what we're going to do is we're going to ask for proof of the LLC documents. You want to make sure that the borrowers on the loan are the same individuals on the LLC. So Fannie Mae and Freddie Mac does allow that, but you have to request that after closing. And then you'd probably work with the same title company that you closed with in order to help you transfer from your individual name to an LLC. But again, you do have to get permission from the lender just to be careful and avoid the due on sale clause, which is the same for every lender.
Okay, perfect. Yeah, and for anyone who has LLCs and they don't want to do that after the fact, I mean, like Shawn mentioned earlier, you have to go with a portfolio loan or some kind of private loan. And we do have a lender on our website that can do those, but just bear in mind that you are going to have a higher interest rate with those typically, and you're going to have higher closing costs. So just keep that in mind.
Just to add to that, Aristotle, there's other ways to do asset protection. So LLCs for asset protection. So there's a couple other ways that I've seen some investors use. One is a trust. You can put it in the name of a trust. If you meet the Fannie Mae, Freddie Mac guidelines up front, you can go into a trust from day one. I've also seen other investors use a umbrella policy with their insurance agent to add it to the umbrella policy. So there are other ways to do asset protection in addition to the LLCs.
Megan asks, how do you anticipate mortgage rates going this year as the Fed continues to raise the rates?
I wish I knew. I mean, they're probably going to raise rates again next month. They're saying 0.5%. They're probably going to raise it again after that. So the next raise next week is already built into the market. So again, the rate they're raising is between the banks that they're raising rates, the federal fund rate. It's not really mortgage rates. Now they're trying to correct inflation right now by bumping the rates where they have. 2 or 3 years ago, they raised rates 6 or 7 times in a year and turned around and realized that it didn't work, and they lowered it back 5, 6 times. So there is no rhyme or reason right now besides the fact that they're trying to help control inflation at this point. So I don't see rates going much higher. I mean, I do think they'll get maybe another 1/4 to 0.5% higher, but in my opinion, though, they will come back down eventually. Just don't know how long that'll take.
Hey, Shawn, since you've been in the business for so long, what are the rates now compared to what they were in 2009, for example? Are they just a little higher than they were? Because I mean, what were the rates back in 2009?
I didn't have that, but I think it was the high 6s, low 7s back in that time period, and that was the highest it was in my 29 careers.
Okay, so we're back where they were. So yeah, I mean, so it's not like we haven't been here before. You know, people tend to have short-term memories, and they're like, oh my gosh, the rates have never been this high. It's like, yeah, they have been this high before. But like you said, you know, no one knows what's going to happen. But rates haven't been, you know, 8, 9%, 10%, you know, on a 30-year fixed loan in a very, very long time. I don't know if we'll ever see that, but we could. Anything's possible, right? But like you said, we're pretty much back where we were in 2009, and just have to slow things down. That's all. So,
I mean, basically, in today's market, also, you're seeing, although rates are slightly higher, you are seeing rents going up. So rents are going up. So basically, that's offsetting higher rates. And as you shared with me offline, Aristotle, I mean, your mortgage rate is a fixed rate product. So as your mortgage is going up, your ROI is changing every year for the positive. And your first year, what did you say? The first year looks like it's the worst because again, your rate is fixed for 30 years most of the time, but your rents are going to continue to increase over time. And property values, they're still predicting them to go up 5 to 7% the next few years.
Right. And I don't have this stat on me, but you know, back in 2009, when the financial markets collapsed and the mortgage meltdown happened, rents went down a little bit everywhere in the U.S., but they didn't go down as much as people think they would. So just keep that in mind. So people say, well, if they're worried about a crash happening, stock market crash, real estate crash, whatever you want to think, COVID crash, you know, rents historically have always been pretty good. I mean, they've gone up and down, of course, but it's not like a $1,300 a month house went to $800 a month. You know, I mean, they didn't do that in 2009. So like Shawn said, yeah, your rents are going to slowly increase too. So if you're making $50 a month on a new construction home, the year after that, you might be making, $30 to $50 more a month, and that's just something to keep in mind. And so your cash flow situation will get better as time goes on. So, all right, so look at a couple more questions here. Shawn mentioned trust. Is that a land trust? Fannie and Freddie will Fannie and Freddie allow you to close in the name of the land trust? I don't know if you want to get into legal stuff.
Not in the legal stuff. Usually a land trust will not work.
Land trust will not work. Okay.
Family trust.
Okay. Yeah, for those who want more information about that, so we've done a lot of really good webinars with our preferred attorney, Anderson Advisors. You can go on our website under the resources tab and look under the asset protection section there, and you'll see Anderson Advisors. And we've done a lot we just did one with Clint Coons, who's one of the founding partners of Anderson. I think we did that one in January. He talks to great extent about LLCs and all this stuff. So if you guys want to go back and watch that, for anyone who's interested in that information, I highly recommend you do that. They're a great company to work with. So let's wrap up here and talk about Shawn. So yeah, basically, if you want to contact Shawn, you go to ShawnHuss.com. We still need to say the www in there, but ShawnHuss.com. You can also go under the, when you log into RealWealth.com, you go under the resources under lenders, you'll see Shawn under Warsaw Federal. That's his bank. That's a bank he works with. And you can see it there. And definitely give Shawn a call if you have any questions. You want him to run through some scenarios. Maybe you're thinking about doing a cash out refinance on your rental or your primary, or you want to talk with us as well, an investment counselor about a strategy. Let us know. We are here to help you. We've got a lot of different ways to maximize your situation and what you're thinking about doing. So yeah, thank you for watching. So Shawn, do you have any last comments or anything that you wanted to add?
No, I greatly appreciate the opportunity. Like I said, the partnership over the last 14, 15 years has been awesome with the RealWealth Group. They're awesome partners to have as you continue to grow your real estate portfolio. Mortgage rates are up, but do not let that discourage you.
That's right. That's right. Yeah, so I appreciate it. And again, if you have any questions, contact Shawn or contact your investment counselor here. And I appreciate everyone tuning in. And thanks for joining us again, Shawn. Take care.
All right. Take care, everybody. Thank you.
All right.